Hello, welcome to another segment of the podcast. My guest host once again is Mr. Richard Advani from Supreme Lending. My name is SeeWing Yee from the Yee Real Estate Network, and our company for the past almost 20 years, we help investors from anywhere in the U.S. to buy out-of-state turnkey remote investing, and we offer off-market opportunities for free member of our organizations, and we target cash flow properties in good locations in the country. And we work as a team with many financial professionals, and one of the important cog member of our team is our lending professionals, companies that specialize in investment loans to assist with financing of real estate investors. And Mr. Richard Advani and his company has been doing it for a very, very long time. His company has been doing loans for not only for my network of investors, but other investors from all over the country, especially in California. So he does investment financing loans for all 50 states. He also does owner-occupied primary home lender buyers as well throughout the country as well. So he's been doing it for a very, very long time, and he's one of the top loan companies out there in the country. So without further ado, Mr. Richard Advani, welcome on this webinar, and we can talk about the new lending changes, very fairly significant, and we're gonna talk about for the next 15-20 minutes. We talk about the homeowners, owner-occupied lending changes, as well as investment loans as well. So without further ado, let me share the screen, and it's only going to be a 5-slide show. So let me start off by saying, Richard, thank you once again. You and I have been partnering on a lot of podcasts. We will continue to do so. I know you have a very, very busy schedule all the time, doing a lot of loans. And right now you happen to be on vacation in Hawaii, which is awesome. Anyway, so this first slide pretty much start off by saying just a review of what's happening these past 12 months. As home prices soar, the lending industry has increased the loan limits so to accommodate the what's going on in the real estate industry. So Richard, I'm going to ask you to start off by saying that let's go over the owner-occupied home buyers, how this new loan increases affects the first, especially the first-time home buyers of a primary home throughout the country, and so go ahead and you can get started.
Yeah, absolutely. And yeah, nice to join everyone again. As you mentioned, the Fannie Mae, Freddie Mac, the overall loan limit, which goes up every year as house prices go up, has really, really gone up significantly in this last cycle. So for 2022, the FHFA increased those loan limits from, they were really in the mid fives, or as for the base loan limit allowed, and they've increased it all the way almost to about 650,000. Now, generally across the country, you have the Fannie Mae low loan limits, which apply everywhere, and then certain counties and certain states have a high loan limit, which allows them to go even higher. And that low loan limit has gone up so significantly over the past 2 or 3 years that you can get a Fannie Mae loan now at $650,000 in every market across the country. And then you throw in high loan limit markets like San Francisco or Orange County or Los Angeles County, and they've increased those to, as you can see from the flyer, $970,000. And that's huge, because typically when you would go into that $600,000, $700,000, $800,000, $900,000 loan amount range, it would mean that you fall in that jumbo loan space. And jumbo loans typically needed higher down payments, close to 20% down a lot of the times. And the qualification criteria was quite a bit more stringent as well. So, once again, having this jump to nationally 647, 650,000, and then the high market counties almost to 1 million is huge. But it also, to me, it also bolsters that the current real estate environment and current prices probably are here to stay for a while. And, a lot of the loan products out there are getting tweaked and tailored to supporting, obviously, these higher loan amount ranges with the higher house price ranges. So it's overall great news, obviously, for first-time home buyers, for investors as well. I think it's good news for the overall real estate environment.
Yes, I do have a very important question. Now that the conforming loan limits, look, as you can see, especially in high-cost areas in California and in New Jersey, in New York State, and what have you, as you can see, $970,000. Without this loan limit increase, if prior to this new change, a primary home buyer, a owner-occupied buyer, if they want to buy a $900,000 property in California, they have to venture into the jumbo loan category, which is, like you said, require 20% down. Now the jumbo loan guideline is pretty much out the window. This increasing this loan limit in California, in this case, $970K, a owner-occupied potential buyer using this $970K max loan does not need 20% down. All they need is 5-10% down and still qualify for this increase.
5%, yeah, 5% down, believe it or not. There's no reason not to go buy a primary home right now with where, if you don't own one, 5% down on almost 970 loan is about $1 million property, and you're putting 5% down it's absolutely incredible.
Yeah. What about the if someone, based on this new higher loan limit, or if somebody put less than 20% down, for 5%, 10% down, as we just discussed, do they need a private mortgage insurance on top of that?
Yeah, you still will have PMI, although PMI is not quite the evil that it used to be. The last 5 or 6 years, PMI has really evolved to where it's not super expensive on a monthly basis. I would need to check to get more specifics on something like a $970 to $1 million loan, but it's not going to be more typically than a couple $100 a month, which is great because 5 or 6 years ago, a $970,000 loan would have probably $400 or $500 a month in PMI.
So yeah, some of the misconception out there I've been hearing is that for somebody who want to buy a higher price home, especially in California, the cost of housing is so high. I live in the Bay Area for many years, and you live in Southern California for many years, and so we clearly live in a high cost area. But the misconception, as I understand, that the PMI will add another, even on this loan, on a $900,000 loan, for example, right now, based on this new increased loan limit, someone who are not informed about this new loan change, they may think with a PMI, the private mortgage insurance for a $900,000 loan could be another $500 or even $1,000 more of monthly payment on top of the mortgage interest, taxes, and insurance. That's not true. You said only.
No, that's not. The factor for a rental property is 0.55%, which means for an investor, if you were to take a $970,000 conventional loan, and obviously investors, you have to put at least 15% down, but for an investor, you're looking at about $400 or $500 a month on that type of purchase price range. For primary home buyers, it's significantly less. It would be typically under $200, $220 a month in that scenario.
That makes a big difference. As a matter of fact, my son, who's trying to buy a primary home here in the Bay Area, he thought he must put a 20% down payment. I keep telling him, you don't have to put 20% down. You need to get the PMI, put lower down payments so you can buy more higher price homes. So that's good to know. I'm going to pass the message not only to my son, but who's trying to buy right now. He's having a lot of problem getting bid out. It's amazing. Right now, we're talking November, December 2021, and there are still multiple offers and bidding wars here in the San Francisco Bay Area. 15-20% above asking, just so you know, Richard. It's based on it's amazing. People thinking, yeah, there's a slowdown element toward the holiday season, but depending on what area in the U.S., at least here in the Bay Area, I have not, depending on what neighborhood, I have not seen any slowdown of buying activities, and home prices are still skyrocketing. Speaking of that, as you can see the next slideshow, U.S. House prices have increased 18.5% year over year, ending the third quarter 2021. So which is mind-boggling. We may not need to expand on this. Let me look at the next slideshow.
Yeah, I'm trying to see here if I can find the PMI list as we're talking, so then I can give you a little more accurate number.
Yeah. If anybody out there who's listening to this podcast, you can contact myself or Richard. Our contact information will be at the bottom of the video. We will clarify the calculation of what is the PMI if you put less than 20% down payment for primary home buyers. We're talking for owner-occupied buyers. So I just want to make that clear distinction because investment loans are a little bit different. So we're going to focus a little bit more on a primary home buyers on this particular segment. Normally, we talk mostly investment loans, but on this slideshow, again, in many of those areas in the country, we have seen double-digit appreciation in Idaho, number 1, Utah, number 2, Arizona, number 3, Montana, and Florida. I can't understand they did not mention Texas because Texas is going through some mind-blowing appreciation as well in the past year. And then they talk about the 5 lowest areas for appreciation. We're talking Washington, D.C., North Dakota, Louisiana, Maryland, and Iowa. And even these locations have double-digit appreciation, as you can see, 8 to 13%. So it's mind-boggling. I mean, you can just, this is amazing. So, okay, let's talk about, I know this slideshow talks about the last few months of the 30-year fixed rate mortgage. In a way, you see a little bit up and down. So can you, Richard, since you are in the loan mortgage industry, at least in the past 6 months, what type of fluctuations have you seen in terms of the 30-year mortgage fixed rates?
Absolutely, yeah. I mean, rates are generally trending upwards, right? The 10-year Treasury bond is up 25-30% this year. And a lot of people don't realize that mortgage rates are not based on the Fed rate or the prime rate. When I talk to clients and I say, hey, the rates are moving up, they're like, well, why? The Feds haven't changed the rate yet. Well, fixed mortgage rates have nothing to do with the Fed rate. They move loosely based on the 10-year Treasury bond. If you have an iPhone, I know most of you do, go into your stock section, type in TN for Nancy X, and it'll actually pull up the 10-year Treasury bond graph and hopefully take some of the mystery out of what's happening with rates. But generally, if you see that Treasury bond go up 2 or 3%, rates obviously are moving up with it. And, contrary, if you see it move down, it's going to move down. The general consensus is that, rates are probably going to continue to move up into next year, another 1/4 to 3/8%. Now, the good news is rates are still incredibly, incredibly low and attractive. With 20% down on a rental, you can still get in the high 3s. You have to pay some points, 25% down reduces some of those points. But you guys got to keep in mind, prior to 2 years ago in the pandemic and this super duper low rate environment, primary homes were in the high 3s. We're still at a point, even with a rally upwards of 3/8 to 0.5%, that you can still get a rental under 4%. So rates are still historically low, over the last 100 years, but even, we're still close to the bottom in the last 10 years. So it's still a great time to obviously get a low rate and, once again, they are only going to still go up from here. I don't think they're going to really move down. So
exactly. As this final slide indicates, it says right here, Fannie Mae anticipates the benchmark for 30-year fixed rate mortgage for the first quarter of 2022 is a mere 3.2%, and then the Mortgage Bankers Association also forecasts the rate for the first part of next year, 2022, is around 3.3 to less than 4%. So, and then CoreLogic also mentioned that the rate will be around the mid threes for owner-occupied buyers. So still very, like you said, Richard, is a very extremely low rate. So this is if this is not an urgent, call for any potential real estate buyers to take advantage of this 30-year fixed rate, it's so funny. It's just mortgages, debt, good debt, real estate is a main driver to create real estate wealth. And I you and I, Richard, right? We try to motivate and inspire not only primary home owner-occupied buyers, but real estate investors, potential real estate investors as well, to get in the market, pull the trigger and get this amazing, great mortgages where, in a world where, we are seeing rampant inflation, up to 20-30% inflation rate. And yet, the mortgage, the lending part of it is a fixed rate. What an amazing, powerful wealth building tool. So what's your one final, before we log out, so what is your recap about the mortgage rate and how it impacts the owner occupied buyers and investors moving forward, and what's your message to the?
Well, as you said, I mean, real estate is obviously a great way to build wealth, but you factor in a 30-year fixed mortgage. It's such an amazing hedge against inflation. And you always hear that, and I've always heard that, and I understood what it meant, but to actually be experiencing it now, with a lot of us that had rentals for 6, 8, 10 years, and with the hyperinflation that's happening now, with the government printing and handing out money, obviously the money's not worth quite as much. So we've seen cost of bread go up, cost of rice go up, cost of gas go up, cost of everything go up, right? Think about it. 10 years ago, I feel like you could buy a luxury car for $40,000. Now you can, fully loaded Camry costs over $40,000. But what hasn't changed? Our mortgage payments, right? Our mortgage payments are exactly the same because it's a 30-year fix is when I got, some of these properties 6 to 8 years ago. But along with everything going up, so is rent. And, a property that 8 years ago, a lot of us bought making $350 a month in rent, maybe a 10%, 8% return. Well, in the last year and a half alone, the rents have gone up $200 or $300, which, you're like, oh, okay, well, $200 or $300, that's great. Well, keep in mind, I bought the property with only $300 a month in cash flow, and it was an amazing investment. Now there's $600 a month in cash flow. Now my return's close to 20%. And on top of that, you're paying down your balance a lot quicker now because that's how a 30-year fix works, right? Every payment you make, you pay more and more principal and less interest. So when you're 8 to 10 years in, you're paying a lot of principal. And that, ladies and gentlemen, is how you build wealth with real estate. The hedge against inflation, looking at it long-term, you start getting the return on amortization because now you're paying down, your loan balance as well. So I am definitely a proponent of leverage. I don't believe in over leverage. I don't believe in maxing out your portfolio. But, if you're not using leverage, statistically and mathematically, you're getting a return probably at least half of what you could be getting with leverage. So, definitely rates are still low. Now's the time to get off the sidelines. And if you don't own rentals, it's a good time to do it, especially with the fixed rates this low.
Oh yeah, Richard. I don't know how many times we have to mention this. If the investors doesn't get it, I don't know. But in fact, we are segueing into another segment of this presentation. This is the second half of our podcast. This next 10 minutes, we could talk about the rising rent, as we just discussed, because of a lack of homes to buy and lack of homes to rent, and the affordability factor. We are seeing a historical acceleration of rents. So, so like you said, I mean, I've seen, my own properties and as well as yours, we have seen 15 to 20% rental increase. Our property management has been encouraging us to raise the rent, and we're getting in some market that we're promoting our rental properties. I mean, there are bidding wars by potential renters. People, we are promoting home, as you know, Richard. You help our investors get financing. So we speak even right now. I mean, my investors buying home in Austin, Texas, and San Antonio, and in Cape Coral, and Central Florida, and North Carolina. Those single-family home new builds are, like 275K, 300K, and it's renting for like 2,300. I mean, that's a good ratio, 0.007% rent to value ratio. We're talking like 6% cap rate. So, I mean, because, we're asking ourselves, I mean, what kind of renters are paying us $2,300 to $2,400 to rent our $300,000, 3-bedroom, 2-bath, single-family home, like 1,500 square foot. I mean, people paying 2,400, they are making like 70 or 80, 100 grand per year salary. I mean, we're having renters would be more than happy to live at this home, and we put 20% down on a 300K single-family home. If a renter is paying 2,400, just do the math. I mean, the monthly net cash flow is around $500, even more, give or take. So Richard, I mean, you've been doing a lot of investment loans, especially lately. I mean, even though we see double-digit appreciation of home prices, and then we're seeing also double-digit increases in rent. So go figure, right? I mean, yeah, I mean, people are migrating into to the suburbs. People want to have more space. They want to have a backyard. They want a single-family home to live and to rent. Many of the renters cannot afford to buy a home because of for various reasons. They just move into an area they're not ready to buy. They don't have the down payment. They don't have the credit. They don't want the responsibility of ownership. They rather rent. So can you share with the audience why the rent has skyrocketed all over the country? There are bidding war by renters. There are lack of homes to buy and rent. So what do you see yourself? What is your thought about this? And not only now, but the next few years and beyond, what's the rental situation is going to be for in this rental market? What are your thoughts?
Yeah, I mean, that's tough to tell, really. I'm not an economist, but what I will tell you is it's simple supply and demand, right? Anytime there's a bidding war, whether it's you're buying or renting, that's because there's a lot more demand than supply, and that demand and supply variance is really not just as rentals, it's the overall housing market, right? There's, I think you're saying, what is it, the next 4 years they need to build 2-3 million homes nationally. I think they're on track to build a quarter of that. And I don't know the exact numbers, but I remember it was they're basically, as a country, we're on track to build a quarter of the housing that we need. So I don't see this supply and demand issue kind of sorting itself out anytime soon. And in general, too, you got to look logically, right? Take away the economy, take away finance, take away everything, right? People are living longer and longer, right? And land isn't growing. So there's more and more people on this earth every single day, and people are going to continue to live longer. The housing crunch nationally and globally is not going anywhere. If anything, it's going to get potentially worse because there's going to be more and more people on this earth as medical technologies and everything increase. So there's always going to be this supply and demand issue. And I think that's what makes real estate beautiful. And that's what made it beautiful for the last 60, 70, 80 years, right? We know our parents invested in real estate and have done extremely well because this fundamental problem is not a new problem, right? It's a problem that's been in existence since homes were being built almost, I'm sure. There's never been enough. And, maybe things will change 10 years from now. Maybe you can 3D print a house in your garage. Who knows? But at the moment, I don't know how to do that. Most of us don't. One more thing to add, too. I did was able to price up a PMI scenario for a $910,000 primary home loan amount, 5% down, just 5%. The PMI was $166 a month.
Really?
Yep.
That is
166.
so. Yeah, what's the formula? If you know the exact formula, that's very very good news to hear.
I think it's 0.18. I think is the factor for primary home PMI, which takes you to about that $166 a month. But yeah, I mean, if you look at return on investment, even if you had the 20% down, right? Put 5% down, take that PMI, it's cheap. You're basically accessing 15% of your money for $166 a month, right? So take that additional $150,000 and go buy 3 or 4 rentals and buy your primary home.
Yeah, I agree. I mean, we cannot predict the future, but once, even if you put down 5% down payment to buy a primary home, you have to pay PMI. In the next few years, if the house continue to appreciate, little by little, once you have like 80% loan to value on your home, you can eliminate PMI at that time in the future. Am I correct?
Correct. You generally need to have PMI on there for at least 3 to 5 years, regardless of whether you hit that 78% loan to value amount. So factor that in. It's going to be on there for 3 to 5 years. But at that amount, I mean, it's silly it would be silly to put a huge amount of money down when you can, of course, buy something with 5% down and still pay such a minimal amount on PMI. And once again, as you know too, I know you even you're surprised. On a $900,000 house, PMI used to be $500 to $600 a month all day long. Now you're talking $166 a month. So yes, house prices are high right now, highest they've ever been. It's hard for young people to buy homes. However, we have all these tools that people aren't discussing, right? Rates are the lowest they've been in a long time. So you take a 3.25% rate on a primary home versus, let's say the average for the last 15 years was 4.5%, right? That 1% is gaining you an additional $150,000 in a house for the same monthly payment. Then you take into account low down payment, low PMI. So PMI, you're saving $400 a month from what it would traditionally be. So yes, house prices are higher, but you have the low interest rates, you have the low PMI, you have all these amazing things that kind of counteract that. So yeah, I mean, a lot of people ask, is it still a good time to buy a house? And look, in the perfect world, we'd all love to time it, right? Let's buy super low and make all this money. And a lot of us have, but we bought super low, not because we're brilliant geniuses that could foresee the future. It's because we weren't sitting on the sidelines, and instead we were being active and we were buying. And, if I buy a house in Texas today for $350,000 and prices drop to $290,000 in 2 years somehow, guess what I'm going to do? I'm going to buy another house at $290 now and bring my dollar cost average down. It doesn't change the fundamentals on what you bought that property on, the cash flow, the rent, all of that.
Absolutely, Richard. I mean, look, you doing loans, every single day. I mean, when people come to you to get loans, I mean, they are already motivated. So good for you, right? I mean, for me, okay, I run a real estate investment club, and over the years, although a lot of my investors are buying, but at the same time, the majority of my investors on my database, they still are sitting on the sideline. It's just it's a function of fear. Fear, FEAR. I mean, my definition of fear is false evidence appearing real. So, yeah, the human nature, Richard, is that most people, no matter what, under ideal circumstances, under not so ideal circumstances, they just cannot pull the trigger. And we can't. You and I can't I can only lead a horse into the well. I cannot force him to drink. So
that's good. There's more water for the rest of us then if they don't want any.
Exactly. So yeah. So the key is pull the trigger. If you have the finances, if you have set up a financial plan, set up your real estate goal, and take action, commit to the goal. Overcome all the negativity out there, and there's so much of it. So just pull the trigger. invest for the long term, stay the course, invest in a good market, buy cash flow properties, have a good team to help you manage your properties. We all do that. So you and I work together as a team, right? You help our investors to get the loans. You are a very important cog of the team scenario of wealth building. So thank you so much for helping our investors all these years. So before I let you go, you have any one quick final? I know you on vacation in Hawaii. Oh my goodness, good for you. So any one final thought before we sign off?
No, just as we said, it's still a great time to go and buy real estate. It's a great time in terms of financing options available. So, get off the sidelines and go buy something. And if you're in the Bay Area and you're like, I can't even buy something for $1 million and I rent and, it's not affordable, then go buy a 4-unit for $2 million because you could use rental income on those other units to now qualify for a higher priced property. So, give me a call and we can discuss those strategies if it's something you're interested in.
Absolutely. Thank you so much, Richard Advani from Supreme Funding and Supreme Lending.
We lend and we fund. It's okay.
There you go. I mean, your information will be on my video description. Don't worry. So thank you so much, Richard Advani, and enjoy the rest of your vacation in Hawaii. Have a nice day. Bye-bye.